Let's get to our closing bell exchange mercifully. Today with us is Greg Yip from the Wall Street Journal, who pretty much covered this entire topic in a terrific column in the Journal today. I hope you get to see that. Ken Mahoney from Mahoney Asset Management is also with us here at Post 9. So is Peter Costa from Empire Executions. And Rick Santelli, we're missing you. He's sitting in Chicago while the rest of us are sitting at this round table here. So, Greg, where do you stand on this whole thing? Could we talk ourselves into a recession if the markets continue this downslide?
Look, I think that my instincts are with Steve, is that the economy is basically about what the economic data is telling us. The strong jobs in January, the strong retail sales. It's very hard to see in the data what is actually a recession. But we know that one reason all of us have such a terrible job at forecasting these things is because there's such a big psychological component. Right. There's a lot of businesses out there trying to decide, is this the right time to make that investment, to hire that employee? They look at the market down and they have second thoughts. We just heard Chuck Robbins from Cisco report that orders have been light precisely because business customers are looking at the market and they're wondering, is this the right time to make that investment? Best Buy got downgraded by an analyst today because they thought that consumer discretionary is the next thing to suffer. And the final thing to keep in mind, and by the way, I don't think we'll have a recession, but I do think the odds are a little uncomfortably high. But the other thing to keep in mind is that our cruising speed in this economy is very low. It's only around 2%. By definition, the closer you are to the ground, the easier it is to crash.
Higher margin of error, right.
Ken, how are you expressing confidence, or are you not in this market? What are you doing here?
Yeah, we actually look at the market as the leading economic indicator, and a lot of stuff that we're looking at is our rearview mirror stuff. So we're unfortunately kind of negative. Right now, we have lower lows, lower highs in the S&P. We look at days like today, we sell into these rallies.
Again, especially the banks.
Yeah, especially the banks. You know, the banks here got a nice lift today on buybacks and so forth. And there's some optimism, but remember, they're an optimistic bunch anyway. But the market's really telling you it's a flattening yield curve. Okay, 14 countries that I count have negative rates. That's a headwind for earnings. I mean, I don't know how you get through that. So you were definitely negative on banks.
Peter, you famously got back in at 1865 on the S&P and acknowledged that you may be early in that. You have been.
Well, I have been.
What are you doing now?
I'd just like to say something about candidate Leisman's presentation.
Yes.
If you were Janet Yellen and you saw that, you'd be raising rates the next meeting, because that just shows you, oh, we got all this bright.
And that was the first thing she mentioned in her testimony was, hey, look at jobs.
Yeah, look at jobs. I mean, I don't think it's going to happen, and I don't think it should happen. But, you know, there are certain things that are starting to make you believe that that's potentially could happen. But, no, I got in a little early, yeah. But, you know, we've had a couple of dips where I've gotten back in as well. So I don't like timing it, but I do think that there are opportunities. You know, it's also my time frame is a lot different than, you know, some people, you know, their time frame might be 3 months. Mine's a lot longer. I can bite the bullet for a little bit.
Rick, I'd love to know where you come down on this. Do you think the Fed should be paying attention to kind of like real macroeconomic variables or the market financial signals?
Oh, I think they should be looking at it all. And I'm always shocked at, in my impression, how little they look at. Janet Yellen still talks as if the dollar's at 100. Now, I know 96 is only 4% away. But, you know, the Fed should be looking at everything, just like traders do in real time, handicapping real changes. So, yes, they should be looking at it all. But I think what they should be looking at the most is how the Japanese market has responded since the 29th of January. When they did their negative push, okay? Nothing is better to educate than actually using the eyesight, the sense of seeing, and it just seems to be lost. I mean, negative interest rates is the story this week, and my guess is it's going to be the story for a lot of weeks. Now, maybe Japan can use the test tube some more and try to help the condition of their stock market and the counterintuitive aftermath of their currency rally, but this is groundbreaking. This is huge, and I think that the world should be a bit nervous about negative interest rates. I think it's a horrible idea, and Japan seems to be doubling down on the notion if you've read some of the latest headlines. And one final thought. I really enjoy that piece that Steve did. I guess what I remember most is in 2013, 2014, and part of 2015, releasing the numbers, 8:30 Eastern, every day just about, thinking the numbers weren't that great, and the stock market kept making record after record after record.
Right.
You know why the stock market looks so confusing now? It's because everybody forgot how confusing it was when it did nothing but go up and ignore data that was at best mediocre. And that's when we considered it good.
Yeah, that was a pretty good 5-6 year rally we had going on there. Greg, how much of this, though, are we not attributing enough to the international influence on our own economy? Anecdotally, you know, commodity inflation that we experienced in this country was not our fault. It was China and the huge demand. Now it's going the other direction right now. How much of that should we be taking into consideration as well?
Well, look, China is 10% of the world GDP now. 15 years ago it was 2%. So just arithmetically, we have to care more than we used to. A big chunk of S&P 500 revenue, Dom, I think, was talking about revenues being very weak. That's because of the translation of the very big rise in the dollar. So the stock market in particular has to be very sensitive to what's going on in the international scene. It's harder to make the case that the U.S. consumer or the U.S. business that sells to the U.S. consumer should be equally worried. In fact, if you've seen the latest confidence numbers, it kind of looks like we're starting to finally see a little bit of a lift from those low gasoline prices. So I take a little bit of comfort from what we've seen just in the last 48 hours that some of the positives are finally beginning to be felt and that we may be hitting bottom in terms of how bad the international influences can be.
I also wonder, is the market telling us as well that, like Rick's saying, it doesn't like the idea of negative interest rates, but that if the Fed could kind of come back in with some talk about quantitative easing and maybe other central banks, it shouldn't necessarily have to be the Fed, but the dollar's involved, you know, have they run out of things to buy? Do they just not like going that route? I mean, why is everybody going negative instead of going to asset purchases?
So I think there's two things the market is worried about with respect to the Fed. One is that they still have that dot plot out there that tells us their base case is to raise rates this year, and at least for 4 or 5 weeks they've been saying that's a mistake. Janet Yellen did not capitulate yesterday and say, you're right, we're not going to do that. She gave about as strong a signal as she could that there will be a pause coming, but she did not capitulate, and she couldn't because they look at the data. But I think underneath that is something else. They're just worried. Even if the Fed did capitulate, what could they do? They've only got 25 basis points.
And that's the point, that you're watching Janet Yellen and, you know, being grilled by lawmakers. It should be the other way around. She should be able to ask questions to lawmakers and say, what have you done on the fiscal side? We're putting so much emphasis on monetary policy. There's not much you can do there. I mean, somewhere along the way, you have to say, lawmakers, I'm sorry, what can you do? I mean, that's more surgical when it comes to tax and spending, whereby monetary policies is just a blunt instrument. So, you know, if you really want to get this thing going, you really have to look at the fiscal side of things.
Peter, a 300-point rally right now after 4 consecutive down days this week, not counting last Friday's big sell-off as well. What do you make of this bounce? And, you know, we're going to talk oil next segment, but oil's leading this charge clearly.
It's oil, I mean, leading it right now. I think there was also some positive data this morning. You know, we've been under a lot of pressure, and sometimes there are these bounces, and, you know, with the way the market is, you know, you have the 300-point moves on the downside. Everybody can understand that. But the moves on the upside, even though, you know, it's churning. It's a lot of churning. And now that people are rotating back into certain sectors, you know, there's certain good, you know, positive, like the financials, for example.
Right.
You know, and if that's a start, to see that happening with that more money moving into the financials again, that's actually a very good signal. I'm not going to say that that's going to happen, but I think that if you see that continued, you know, that's a positive.
Well, if you're looking to buy financials, you can buy them from Ken Mahoney because he's.
I'll give them to you.
I'm not looking for it.
Put it together there. Thanks, guys. Appreciate it. Have a good long weekend.
Thanks a lot, everybody. 45 minutes.